You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host. As always, this week we've got our number one mortgage broker in the room. It's Sam Carrello. Sam, you've been on holiday for a few weeks, mate, but the tan still hasn't worn off.
It hasn't, mate. Yeah, I had a great trip away, which was nice, and I've come back, and it's pretty hectic in the Perth market at the moment.
No surprises. We've just hit the lowest stock on market in West Australia's history, certainly on a per capita rate, and definitely this century. Did you know, Sam, we've breached for the first time this century the 3,000 property mark. We have less than 3,000 properties on the market in Western Australia right now. Isn't that unbelievable?
It's crazy, and speaking to clients out there, they're feeling it and seeing it as well, because I think of those 3,000, it's not 3,000 houses, it's land, house and apartment, isn't it?
That's right. And when we're speaking in May, the interesting dichotomy between the conversation we're going to have today and the feeling you've had, especially in the last few weeks, compared to May was just coming through two elections and the Trump tariff noise. And there was a lot of noise in the room that was affecting people's ability to make decisions. FOMO certainly wasn't there. The market was just chuffing along with the fundamentals of demand and supply that was tightening on a weekly basis. It certainly is back now. It feels like it's as busy as it's been. Certainly feels like it was back in that FOMO space about 15 months ago, doesn't it?
Yeah, I think combination of obviously the recent RBA rate cut has given people confidence, and predictions are there may be one or two more to come over the next 6 to 8 months. And then obviously changes with that first home loan deposit scheme with the government bringing that forward. It's definitely created a bit of a stir.
We'll talk about that in detail over the next half an hour, but certainly we've seen it as well in our development space. Land is getting taken up at a rate I haven't seen before. Many contracts per day being signed in our development space, which we haven't seen on our land developments, at least in the last 18 months. And I think it is certainly there's been that momentum, that snowball growing on a weekly basis with rates dropping and the view of rates continually dropping, but also the combination of that 5% deposit scheme, which nearly feels like a marketing scheme, like the building boost felt like 5 years ago. That seems to be the outcome that's happening right now. People bringing forward a lot of buying decisions, even though it's not like it's going to run out anytime soon. It's quite funny. But also things like the HEX debt changes as well. The way that the banks are viewing those debts just makes it easier and easier for younger people right now compared to maybe a year ago to start getting on the property market, despite the fact prices have been rising and are rising aggressively now, not only in the established space, but also in the land space and the construction space.
Yeah, I'd agree with that. And I guess sentiment out there, like speaking to a few of the agents we work with, a lot of the time, if they're taking multiple offers on a property, if they had 4 of that exact property, they'd be able to sell it 4 or 5 times over. Like, the demand's definitely there. I agree. I think the changes, which we'll talk through in the first home loan deposit scheme, it's definitely going to increase that demand side. Don't know what it's going to do about supply. I don't think it helps that, but it's all demand driven. So it'll be interesting to see what happens. Obviously, a record low at the moment with the properties on the market. I'm just wondering whether people are waiting until 1st of October to list now. Typically, spring, you do get a bit of an uplift in terms of listings. So we'll just see what happens, but whether that's changed sellers' views to say maybe we'll hang on, we might have a few more buyers come October 1.
Honestly, I think there's that much confidence in the ownership space right now that people are continually just holding on. They're punting. The longer they hold on, the tighter this market's going to get, the more the book value of their property is going to go up. In the meantime, maybe we'll buy an investment property and add to that demand as well. It's certainly not helping the mobility space, but you can speak to how things are going in refinances or subject sale style loans, reverse mortgages, if any of that's starting to pop across your desk. But it's also self-fulfilling reality right now that we do, yes, usually see selling season bring on, last year we saw it bring on about 40% more stock, which went from 3 and a bit thousand to 5,000, right? So it wasn't mental over that period. But do we expect the same this time? As every week has dropped, I'm expecting it can't go any lower. So we're all surprised right now in this market. At some point, it will naturally inflect back up. It's just at what rate will it start to get back towards 13,000? We thought last year it was going to keep going, and in fact, it did a U-turn again and went straight back down to the record we've just seen. So, yeah, I'm not sure we'll see 5,000 properties on the market in the next 2 months, but it wouldn't be surprising. It would be natural, as you said, for stock on market to start ticking up towards Christmas.
Yeah, I think so. And I think the mobility piece, like you said, is probably a lot of conversations out there is people do want to move, but the ability to move from one property to the next, they don't want to sell before they buy. Something like a bridging loan works well there and people can do it, but it's getting to the point where if they've been in the market 6, 8, 9 months, they're now looking at it and they're going, well, the fees involved to turn it over, I'm not actually getting that much of a better product, or maybe the budget's run out. And what we're seeing is that there is inquiries quite a bit in terms of the refinance and cash out space, where people are probably more nesting, so they're looking to increase or improve where they are now. Because
so renovations, things like that.
Correct, yeah, because they're looking out there and they go, for what I can buy, I actually don't mind where I am, I probably just need a little bit more space.
Yeah, okay. And that's demonstrating people turning to alternatives in the face of failing at the negotiation table. How are your pre-approvals looking? I know that brokers everywhere around Western Australia have a lot of pre-approvals that have been sitting there for months and months, just waiting for their clients to finally get lucky and turn that into a formal approval and obviously a purchase. What's it looking like for you at the moment compared to the last time we were chatting in May?
Yeah, definitely plenty of pre-approvals out there. I think if you're serious about looking, you need to have that pre-approval, because you're not going to get a look in on the offer table, even if you're the highest price, if you're not pre-approved, or a cash offer or a short finance clause, which is what we're doing with our clients. So essentially, we'll get the pre-approval in place. That gives them 90 days at that dollar value. And then when they put an offer on, we just recommend 5 to 7 days for finance.
You're having to do a lot of top-ups or a lot of redos on the pre-approvals because they're going past the 90 days?
For some clients, yes. I think probably in that $600,000 to $800,000 mark. If we were dealing with clients in that space, that's probably the most competitive at the moment, and then really competitive between that 800 to low ones as well. Over that $2 million mark, it's competitive, but not as competitive, which is probably an affordability or serviceability issue.
It's just a function of how many people are in that space in the first place, probably.
Correct.
But at the same time, there's probably the equivalent lack of stock in that space too.
Yeah, and I think if you're spending $2 million on a property, there's $100,000 in stamp duty there. You're probably selling something, so you've got probably 2 to 3% in selling fees. You know, that's a lot of after-tax money to burn if you don't get it right. So it's maybe a little bit more, take your time, make sure it's the perfect thing if you're spending that cash. As in that $600,000 to $800,000 price range, it is that competitive that people are willing to go, yeah, maybe it doesn't have the perfect layout, but we can make it work down the track, or we can turn the 3x1 with a laundry, we can turn that laundry into a bathroom and make it a 3x2, which is what we need.
I'm seeing a lot of inquiries come across our desk of people who were saying, hey, look, I live in Craigie. I've got a mortgage that's $550,000 and my house is now worth 1.2 mil. I fall off my chair when I see those realities for places like Craigie, right? But that's their reality now. Hey, I've got all this equity. I wouldn't mind using that to buy an investment property. It's becoming prevalent now, isn't it, where people are starting to roll that equity into the second and third property.
Yeah, and that's just adding to that demand piece. And an investment property, typically, they are looking in that $600,000 to $800,000 range in Perth. But yeah, everyone, it seems, who's been in property for 5 years, everyone's got equity. It's whether they've got the serviceability and the appetite to then try and find an investment property. And
so how would you be going about that? Essentially, it'd be a cash out on their owner-occupied property so that they've got their deposit ready to go bang, ready to make that investment in whether it's a established unit, a house and land package, or an apartment.
Yeah, depending on their equity position, what you would do is, refinance and then cash out your 20% plus fees and then do a pre-approval for the investment purchase. Some clients are in a position where there's banks who will lend up to $1 million cash out with stated purpose. They may be in a really strong position. They may have a property worth, say, 1.2. They've got a small mortgage on it, and they can actually take out, say they want to spend $800 on an investment, they can actually draw that against their owner occ and have the cash.
And then they can literally just make a cash offer and go, here it is.
Yeah, 7 days we can settle, or 14 days. You might need a little bit longer to do your building and pest inspections, etc. But essentially, we're seeing some really good equity positions at the moment where there's a lot of conversations you're having. If people bought 5 years ago, it's not unlikely that it's doubled in value.
That's right. Let's talk about rates, which is one of the key factors that have built the momentum in demand, but also starting to improve affordability at the moment. Where are we sitting for our basic owner-occupied principal and interest?
Say we have a 20% deposit offset account, you're probably around that 5.4%. There's a couple of lenders slightly cheaper. A couple 5.4 to 5.5 is probably where you're sitting.
Those are the big four banks?
Yeah, correct. Yeah, if you get down to those 70% lends, so with 30% equity, which again we're seeing a lot of clients have these days, as low as, I think the cheapest I got, well, it was a chunky loan, but 5.25%.
Have the banks been passing on? Have you seen the full rate drops? Because it's a bit of a jungle out there with regards to the 1,000 rates available these days. It's a bit opaque, isn't it, when we're trying to compare products?
I've been surprised. So we've had 3 cuts and they've passed all 3 on in full, pretty much. What has happened and what I've seen, and this is what we do when we see our reviews, is that there's clients who potentially signed up for a mortgage a year or 2 ago, and they're actually on a better rate than what I can get the client today.
Why?
The reason for that is the banks have their standard home loan rate, which let's call it 8%, and then they'll give you a discount off that based on your circumstance. So say it's 8%, let's do it nice round numbers for me, make it easy. We'll say a 2.5% discount, so you're on 5.5. 2 years ago, that might have been a 2.7% discount. So that would be a 5.3% rate. And the way the banks play around with these discounts doesn't get the headlines in the media because you're not passing on the full 0.25%. So they can control their flows by saying, cool, that's our headline rate at 8%. Depending on the client and what we're chasing, we can give a discount off that. And I think the discounts have just reduced from what they were probably a year or 2 ago.
Clearly they need the work a bit less than they did a year ago. What about investor rates?
Yeah, investor rates, we're probably sitting around that 565 for investment interest only. There's a couple principal and interest investor rates out there at that 544.
That's interesting, isn't it? It was only a few years ago where there was a marked difference in the rate between an investor loan and an owner-occupied loan. It seems like they've started to compress back together again.
Yeah, the regulatory requirements were removed, I think, a year or 2 ago, where there was only a certain amount of the book that could be investment for the banks. But the banks haven't quite lined up the rates yet, but it is getting compressed in there. There's a few banks, like ME Bank, for example. If you're happy to take principal and interest on your investment loan, they'll let you do owner-occ rates on the investment, pending that the owner-occ debt is higher than the investment debt. So there's a couple little quirks and, I guess, options out there. Ideally, have a chat to your accountant in terms of best structure, in terms of investment interest only versus P&I, especially if you've got owner-occ debt.
Fixed rates. Now, there's obviously a view that rates will be lower sometime in the short-term future. That normally means fixed rates are lower than the variable rate right now, are they?
They are, yeah. So especially for your 2-year rate, a couple banks, that's probably the sweet spot in terms of cheapest rate out there. So you're sitting around that 489 for an owner-occ principal and interest. So that's pricing in potentially 2 rate cuts.
It's an interesting bet to make right now because there doesn't seem to be any expectation out in the industry that it'll be markedly more than 2 rate cuts that we're going to get out of the RBA. But it seems like they're giving it to us in that fix. Normally, they're trying to make a bit of money on us with that gamble.
Yeah, I think with the fixed rate, it's always important to touch on that. Typically, they won't have an offset account. You're limited in how much extra you can repay, which would typically be $5,000 to $10,000 a year. Although the rate may be slightly cheaper, I wouldn't be locking in right now. I think there's a little bit to go on the variable.
Is anyone locking in right now in your book?
Not out of my clients, no. I think everyone's pretty confident there may be 1 or 2 more rate cuts. And typically in Australia, we don't really see a lot of fixed rates. It's different. Like US, you get your 30-year fixed mortgage when you sign up. Australia, it's 1 to 5 years. Pre-COVID, I reckon you were doing probably 10% fixed rates. During COVID, especially at the start, that jumped to probably 99% fixed rates with a variable split on there, just to give them the flexibility to be able to pay back more. And right now, with the forecast of rates to continue to come down, we're not really seeing any fixed rates.
Let's move on to those cherries that are being offered right now, or at least the improvement in home buyers' outlooks with regards to affordability. What we know in the last couple of weeks, which is a big reason you're in the studio today, the 5% guarantee scheme has been expanded. It was planned to start in January, and the threshold has risen to $850,000. It essentially just opens up a big swathe of that really ultra-competitive market you were talking about for first-home buyers whose deposit is a lot lower than 20% to get into the market. And it's been brought forward to October. Obviously, Albo's got enough people yelling at him in the background going, what are you waiting for? Help these kids out. How's it affected you as a broker? And can you walk us through exactly the detail for us on how people can get in the market and when that is?
Yeah, I was speaking to another broker earlier today and saying what we're seeing out there, and I haven't seen this level of inquiry and I don't know if panic's the right word.
Mania.
But yeah, it's pretty wild out there at the moment. So it's 2 thoughts. There's the ones who are going to be first home loan deposit scheme guys, and they're just waiting for the 1st of October. They've got their 5% ready to go. Obviously, the changes to it, so it has increased from $600 to $850 in terms of your purchase price in Metro Perth. They've removed the income caps. So
that's the biggest bit, I reckon.
Yeah, so previously, single was $125,000 a year, couple $200,000. There is no income cap. So you could be a single applicant on $300,000 a year working in the mines. You save your 5% plus your fees, and then you're in. So that's going to add a lot more demand on there in terms of how many people there is. The time before, when they made the amendments, they removed the Australian citizenship, so you can be a citizen or a PR. It doesn't matter. And in terms of the banks, you've got 3 of the big 4, so Westpac, CBA and NAB are on the scheme, as well as guys like St. George. So you've got those big guys on the scheme, and you gain those rates at 5.4%. For example, a client wanting to buy $850, so the top, you'd need, when you factor in your stamp duty, etc., probably about $75,000 all in and fees. If you were to save a 20% deposit, that would have been just over $200,000.
Yeah, and what it's doing is bringing forward these guys' purchasing option years with regards to how long it would have taken for them to save that extra $100,000, but also it's counterbalancing against what is, in my opinion, a pathetic option that is in Keystart, where they have their 5% scheme, but at rates that are extortionate, right?
Yeah, so I think 2% from memory, but yeah, the rate's north of 7%.
Yeah.
So Keystart, yeah, I don't quite see where they will have a place once these scheme changes come in, unless you can't get the difference between the 2 and the 5%.
For me, it'd be if you can't get to 5%, you probably haven't demonstrated the ability to save and work with money in a way that you need to have a mortgage and own a property. It should just be a case of get to 5% to at least demonstrate your discipline in being able to save and manage your books in a personal situation, right?
Yeah, I think obviously we've seen rental as well out there, so single parent families paying rent. Maybe there is a place there for Keystart, but yeah, I agree, 5% minimum to be able to get in on those rates up to $850. I think you're going to see a real big push in that $600 plus to $850 price point range. You're probably going to see them escalate quite quickly. And we've also had some calls from guys who are looking at investment properties, and now they're going, we're looking to spend in that space. We're going to try and bring forward our purchase to the next month, because we think once 1st of October comes around, there's going to be even more people out there to fight with.
We'll just get caught in the wave. I agree with that. And I think what it's going to lead to is the cheapest stuff you can buy in Perth will be up in the 800 to 850 range. And that's what will be for quite a while. And then we'll eventually see the stamp duty threshold have to rise, because there will really just be nothing you can buy for that stamp duty free threshold price. And that will obviously have to come up somewhere close to that $800,000 level. Whether Safioti does it because she politically doesn't need to right now is another question. But that's where the next level will be. Because as you've just mentioned before, having to put in $75,000, half of that's stamp duty.
Correct, yeah, it is. It's about $40,000 in stamp, and that's what it is. But I think the government, no, we won't get political. I was going to say they're chasing e-taxes. It brings forward their stamp duty.
Exactly. So it's a win for everyone here, the governments and homeowners, investors, and for a short period of time, those first home buyers who can get in before it rises again.
Correct, yeah.
Let's talk about the HEX help side of things. Explain to us how the change in the way that is being assessed helps people's affordability.
Yeah, so there's been a couple of banks. I think last time we caught up, it was CBA who were doing it. NAB have entered the fray. CBA, if their calculation is if you're going to pay out your HEX within the next year based on your required repayments from your wage, then they will ignore it. And then if it's going to be paid out within the next 5 years from the required repayments from your wage, they'll take it at a discounted assessment rate. NAB have simplified that, and they've just come out and said if you've got $20,000 or less left on your HEX set, then essentially we won't worry about it, won't include it in your assessment.
Any idea how that's impacting affordability as an example?
Yeah, so there was a client recently paying about $1,400 a month out of his pay for his help debt. It's about just under $17,000 a year. Now, 5 times lending, it's increased him by about $90,000.
Yeah, and that gets people over the line in a lot of spaces, right? Or at least gives them some buffer for the time they're going to need to find that place. Because I'm sure you get into situations where people get a pre-approval for, let's call it $700,000, and then by the time they actually find a property, go, we like it, that's now at $770,000, and they're stuck in a rock and a hard place, aren't they?
Correct. Yeah, a lot of conversations at the moment with the rate cuts, and or if people get a pay rise, it's how much more can I borrow? I think again we mentioned it before. I think if most clients in that $600 to $850 space, if you could give them an extra $20,000 or $30,000, they would take it and they would spend it.
Okay, so these are the structural things that have changed. Rates dropping, 5% guarantee, and HEX debt assessment changes that are assisting people to get into the market. Now, those are the things that have happened to us, really, from a policy and structural perspective. But as clients, as consumers, what can we be doing to optimize that, to get the most juice out of that orange at the moment?
Yeah, there's a few things we can do. So first is obviously credit cards is probably the easy one. Credit cards take away about 5 times borrowing capacity based on limits. So say you had a $10,000 credit card, it reduces your borrowing capacity by about $50,000. So that's a nice, easy one to do. Get rid of your credit card and straight away you'll see an increase in your borrowing capacity. Choice of banks probably a big one and probably doesn't get touched on enough. I know we've touched on rates at the start of today. Rate's important, but if you're not getting approved for the amount you need, there's no point going there.
Let's be really clear here. I think a lot of people still assume that there's some government calculator that all the banks stick to, that if you make $100,000 a year, that every single bank would give you the same amount, $500,000 as a loan.
Yeah.
That's not the case.
No, they've all got their own assessments.
How much does it vary from your bank that gives you the least amount to the highest? As an example, would it be a case where with that $100,000, all else being equal, one bank could be at $350 and another bank could be at $700?
Not that big of a difference. I guess the key changes are your buffer rates. So some banks, like your second tiers, will take a 2% buffer rate versus a 3% buffer rate, which...
That's a 33% difference, right?
Correct, yeah. That's definitely one. The second one is policy. Guys, some banks will take 100% of your overtime and allowances. Other banks will take 80%. Some will shade rent different. Some won't allow negative gearing on properties. So there's different ways you can see the differences in terms of how much you can borrow can be hundreds of thousands between two lenders.
Now, I hate any point where this podcast feels like a sell, but that in itself just emphasizes the need for a mortgage broker. Why anyone would go to a bank without speaking to a broker who understands all these policy nuances and then matching them to your situation is absolutely beyond me. I've seen so many times where someone goes to the bank, they were with a child, they said, yeah, I can only get $450,000, and then a broker comes along somehow through a friend and it turns into $650,000. I still don't understand why people wouldn't take advantage of all that niche knowledge. And I think, to be honest, that's the minority these days, because I'm pretty sure it's about 70% of people get a loan with a broker these days.
I think we're up to about 76, yeah.
Wow.
So the market's definitely a broker market out there. The bank's obviously trying to claw back a bit of that market share. But, example, I had a call yesterday from a client. He's casual, works offshore on the rigs, making $200K.
There'd be a lot of banks who'd say, go away.
Yeah, got his 5 or 10% deposit. And I said, why would you look at those when we can put you on the scheme? So he went to ANZ and they're not on the scheme. And so they said, we're going to charge you mortgage insurance. You're going to need to save this. And our casual policy, you don't quite fit. So we're going to, probably switch him across to a NAB. And he will get the 5% deposit, no mortgage insurance. He'll be able to borrow what he wants and he can do it straight away.
Man, the value there is tens of thousands of dollars right there. So that's really good. And I hope that's the value people get out of listening to podcast episodes like this, is you really start to understand, where do I fit into this conversation and how can I make the most of this?
So I think, like we touched on, is bank choice is important. Rates important, but it's not number one. It's what's going to get you where you need to be. Some of our clients who are looking to maximise borrowing capacity might look at a non-bank lender or second tier with a 2% buffer. You're not married to it for 30 years. Yes, the property's harder to turn over, so you want to be buying a good asset. But if you get in with one of those banks, you can always then refinance out in 24 months' time. Some of the majors have that 1% buffer policy rate, right? So when you refinance, if you're just doing a dollar for dollar refinance, rather than being assessed with the 3% buffer, they assess you with a 1% buffer. Just have to hold that loan for 12 months, good conduct. And then obviously the valuation needs to come in standard terms and conditions. Something like that's not a bad way if you do need to look to try and maximise your borrowing capacity in what is a competitive environment.
It's really a side door to get in. It's not the back door, but it's a side door to get into the same outcome a few years later of the bank that has the best rate, for example. It may not be the bank with the best rate that gets you in the market, but it's the bank with the policies that suit your situation. And then it's a sidestep via a refinance to that ultimate bank you'd like to be with.
Yep. Yeah, and you just need to make sure that, obviously, we can't predict what lending is going to be like in 12 months, but it's a way to potentially get in.
And that's what we know. Lending is so dynamic. So many products out there these days. So many banks changing the type of client they want every day and therefore changing their rates, their policies, and the niches. Definitely, as a consumer, I would say as a listener, take heed to all this advice today. This next few months especially is going to be, if it isn't already, mayhem in this market, especially in that sub $1 million space, as people are working the instigation of the changes to this 5% deposit scheme threshold, and along with being in this tightest market we have now ever seen.
Yeah, I think from me, just make sure you've spoken to your broker. Make sure your pre-approval's there and know exactly what you can do. Some banks will do full assessment on the pre-approval, some are a system, so make sure you ask that question, because you do want a full assessment, just so there's nothing untoward that comes out when you go to move it to a formal approval. But get your pre-approval in place and then just do a nice sharp subject to finance offer 7 days or 10 days, and you should be able to get it turned around in that time.
Sam Carrello, thank you very much for coming in. As always, mate, we'll get you in sometime around Christmas, I reckon, and see how this has all come out in the wash.
Hopefully I've still got my hair by then, we'll see.
Cheers, mate.
Cheers.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!